broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time homebuyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddie Cocciolo.
Good morning, good afternoon, depending where you are sitting here in Canada. Welcome to the July edition of In Conversation with our very own Chief Economist, Dr. Sherry Cooper. Obviously, I'm not our President, Eddie Cocciolo, but I hope that I'm a sufficient backup as I'm your DLC Vice President, Greg Donville. Today, we're going to spend the next hour discussing the great news announced today by the latest Bank of Canada meeting. Excitement and momentum continues to grow and strive with yet another drop in our lending prime. With rates on the decline and the market share of working with a mortgage professional on the rise, this is great news for our Canadian consumers and, of course, our DLC network of mortgage professionals. So just some quick housekeeping items before we dive in. We're going to go through Dr. Sherry Cooper's full presentation, and we'll address any questions we have at the end, but please don't wait. Throughout the presentation, type in your questions into the comment section, and at the end of Sherry's presentation, I will address any of the questions. I'll try to get to all of them, time permitting. So let me just quickly thank our sponsor, FCT, for the great partnership they have with DLC, and of course, the great service they give to all of our borrowers. So on that note, let's talk to Dr. Sherry Cooper, get into the great news that we had today, where once again, Bank of Canada, 2 months in a row, has given us some great news. Sherry, thank you so much for being here. How are you today?
I'm fine, thank you. Greg, this is very good news. And in fact, if anything, the statement today coming from the Bank of Canada and the monetary policy report that was released this morning, both were very dovish. Both are, in fact, they've highlighted that the economy is in excess supply, that monetary policy remains too restrictive, that they believe that inflation is headed towards the 2% target, and further rate cuts are in the pipeline. So all of that will certainly help to improve psychology in what has been a disappointing spring housing season. But I think that as we move forward with lower interest rates this year, continuing next year, we will see a rebound in housing. So I guess with no further ado, we'll move on to my charts. Just as an FYI, everyone, somehow in the process of traveling yesterday, I misplaced my computer. Never a good thing. And so as a result, I see I have just turned around. I'm operating from a iPad, and that's why my picture just flipped.
There you go.
There I
Perfect.
am. I have no idea what causes that. And I'm going to have to ask Natasha, who's behind the scenes here, to change my slides as we progress, because
we're definitely handicapped when we lose our technology. Isn't that the case?
Yeah, always. So, Natasha, can we begin with the first slide? Okay, Bank of Canada easing trajectory. I think it's safe to say that in the next few months, we're going to see a continuation of rate cuts. In addition, the Canadian economy is operating on a soft landing. The next slide shows that. It shows my forecast for annual GDP growth. 2024, this year, 1% growth is likely. And next year, we'll see an uptick in growth to about 2%. Judging from the monetary policy report released today, the Bank of Canada thinks the economy might be a bit stronger than what I've suggested, but only time will tell. And the next slide shows you looking at these data from a quarterly perspective. We haven't seen the third quarter GDP figure yet. The second quarter GDP figure yet, or the third. The Bank of Canada thinks that we're going to get 2.8% growth by the third quarter of this year, which I think is very optimistic. I think that's unlikely. But as we move through this year with continuing rate cuts in 2025, economic activity is likely to pick up. Now, the next chart shows you that while GDP growth has been positive, when you look at GDP per capita, there you see we've seen declines. And in fact, GDP per capita in Canada is little changed from a decade ago. Everyone knows by now that we've had an enormous net influx of population. Population grew by a whopping 3 million new permanent residents and temporary residents in the country in 2023. And we're slated to see something on that order as well in 2024. When you look at the next slide, you see the GDP per capita growth in Canada is falling while it is still rising in the United States. The US, of course, has a very different attitude towards immigration, but it helps to explain why the Bank of Canada is aggressively easing monetary policy while the Federal Reserve, the central bank in the United States, has not been doing so. The following chart shows you that the Canadian economy is far more interest sensitive than the US economy. This just shows you real consumer spending, and the real consumer spending numbers in the US have been much stronger than in Canada. And I think the next slide would show you just exactly why that's the case. Moving on to the next slide, look at how important mortgage debt servicing is in Canada relative to disposable income. In the US, thanks to 30-year mortgages, most of which are fixed rate mortgages, the mortgage debt servicing as a percent of GDP is a small fraction of what it is in Canada. And so as a result, the Canadian economy is far more interest sensitive, and the Bank of Canada understands that. Moving forward to the next one, you can see that there's a roughly 10% gap now between the Canadian and the US economies. And that, by the way, is the biggest gap in per capita GDP since the mid-1960s. So very good reason why the Federal Reserve is unlikely to start cutting interest rates until September, whereas our bank has done so now 2 meetings in a row, and that's likely to continue. The Canadian dollar has been a subject of concern. The next chart just shows you. My view is that Canadian bond yields have rarely been so low relative to US yields, but that in effect is warranted given the relative underperformance of Canada's economy and, of course, the dramatic improvement in inflation in Canada vis-a-vis the US. So moving forward again, you can see that the inflation readings in both countries have diverged considerably. And as a direct result of that, again, Bank of Canada easing, not yet for the Fed. Moving to the next slide, the Canadian dollar will not stop the Bank of Canada from easing. As of just 15 minutes ago, when I last looked at market changes, we've seen the Canadian dollar fall to 72.5 cents since the bank released its monetary policy report and policy statement. So the currency vis-a-vis the US dollar has weakened, but if you were to look at the Canadian dollar vis-a-vis global currencies, particularly the Chinese renminbi, the Canadian dollar, in fact, is a relatively strong currency with respect to almost every other currency except the US dollar. So the Bank of Canada is not going to wait and worry about what's going on in the US. They will continue to ease monetary policy in coming months, barring some very unexpected, unprecedented developments. Now let's look at the labor markets. The latest data have shown a significant increase in the unemployment rate with flat job growth. The next slide shows you that for the month of June, we barely saw an increase, like roughly zero net job growth in Canada for the month of June. The job growth is averaging for the year about 30,000 per month. And that compares to much stronger increases in the number of working age population. So not surprisingly, we are seeing that vacancies are falling, shown in the next chart. The actual vacancies, job vacancies, are returning to more normal levels compared to where they were at the peak of the pandemic. And the next chart shows you that while average employment growth is running at about 30,000 per month, labor force growth has been averaging 54,000 per month. So as a direct result of that, the following chart shows you that the unemployment rate has increased sharply. It's up almost a full percentage point in the past year to a jobless rate of 6.4%. Now, this will eventually put downward pressure on wage inflation. The next chart shows how the drop in vacancy rates has led to the decline in inflation. That those two data series run pretty much contemporaneously. So that's another reason that the Bank of Canada highlighted in terms of their very dovish statement today that they consider monetary policy to be overly restrictive, and in fact, they believe that they will be cutting interest rates at pretty much every decision date between now and the end of next year. Now, the following chart shows you one measure of wage inflation. This is the actual raw data for June. We saw that year over year wages increased by 5.4%. Considerably stronger than what the Bank of Canada would like to see. However, other measures, and in my view, more valid measures of wage inflation, has shown a considerable improvement. If you look at wage inflation adjusted for the type of job, that inflation number now is below 4%, which is very good news. And you really do need, it's similar to the home price index that is adjusted for type of home sold. If you see a month where it's high wage jobs that are rising in number, then wage inflation will look higher than if you were to correct for relative different kinds of jobs. So for similar jobs, the wage inflation numbers have moved down already. We are also seeing, as the next chart suggests, that unit labor cost is being pushed higher by very sluggish productivity growth. Productivity growth has plummeted in Canada, and the problem is that businesses have been reluctant to invest in plant and equipment, and particularly in software and technology. And when you look at technology per worker, those numbers have come down very sharply. So that's another concern of the Bank of Canada, and it makes Canada less competitive in the global marketplace. Now let's look at the inflation data. The Bank of Canada highlighted the good news in the June inflation report. June inflation has fallen to a year-over-year pace of 2.7%. You can see the details of that in the next chart. In May, we had a bit of an uptick from 2.7 in April to 2.9 in May, but it's back down to 2.7 in June. It's boosted mainly by the service sector, and the service sector is the inflation data are biased upward by the shelter component. One might argue that there's no good reason why mortgage interest and rents should be 30% of the overall CPI, but that is exactly what it is in the way we measure the CPI data. Now we know that mortgage interest rates are going to be falling, and that suggests that core inflation will continue to edge downward. The following chart shows you the Bank of Canada's favorite measures for core inflation. And in one case, the CPI trimmed, we see that inflation year over year is about unchanged. Whereas by another measure, the CPI median, the core inflation numbers have come down to 2.6% from 2.8% in May. Now, looking at these data on a moving average basis in the next chart, we see that if you looked at just the 3-month moving average, core inflation has ticked up a bit. But a broader, more valid comparison is to look at the 6-month moving average, because these are volatile numbers. And on a 6-month moving average basis, core inflation is the average of core inflation measures is just shy of, just slightly above 2% already. So that's what Tiff Macklem and company is referring to when he discusses the good news on the inflation front. The Bank of Canada announced today, as was widely expected, shown in the next chart, that they would be cutting the overnight rate by another 25 basis points. That takes the overnight rate down to 4.5%. My chart is not updated because, as I say, my computer has gone MIA. So, but just so you know, our overnight policy rate at 4.5% compares to the equivalent rate in the US at 5.25% to 5.5%. Even with the overnight rate at 4.5%, monetary policy remains very restrictive. When the overnight rate is so far above the 2.7% inflation rate, we know monetary policy is overly restrictive. In addition, I expect that we're going to continue to see the Bank of Canada cut interest rates moving forward. And I also believe now that they'll take the policy rate down to 2.75% by the end of 2025. So I've reduced that forecast from 3% a month ago now to 2.75%, which of course would be very good news for both fixed and variable mortgage rates. Now let's look at the next chart. As of last month, you could see that monetary policy remained very restrictive, as the overnight rate at that time was 215 basis points above the current median CPI inflation number. That gap has closed a bit with the 25 basis point rate cut, but it still remains much higher than what we would ordinarily expect to see. So, the decline in the overnight rate shown in the next chart does imply that we will see the prime rate come down by 25 basis points, which will reduce variable rates on variable rate mortgages. So the prime rate had been at 6.95%. It's headed now for 6.7%. The following chart shows you the 5-year bond yield. The bond yield as of just 15 minutes ago is down 10 basis points from what it was in this chart. 20 basis points from 1 month ago. It's now at 3.2%. So very good news, meaning fixed mortgage rates will be coming down further. The following chart shows you there are 3 more Bank of Canada's decision dates this year: September 4, October 23rd, and December 11th. I am now forecasting that the overnight rate is headed for 2.75% by the end of next year. And that's above the pre-COVID rate of 1.75%. The reason we'll see the overnight rate remain above the pre-COVID rate is because pre-COVID inflation averaged less than 2% over the prior decade. I'm not suggesting we'll go back to that very, very low disinflation rate. But if I'm wrong about 2.75% overnight rates, I will be wrong on the high side rather than the low side. So importantly, the next chart confirms what the Bank of Canada said today, which is inflation has clear downward momentum. And you can see in the following chart exactly what has been contributing to this. The next chart shows you that core inflation is headed below 2%. And where we'll see the biggest movements in core inflation will be in the shelter component, where the shelter figures, if you were to remove shelter from the equation, the core inflation numbers are already just shy of 2%, the target for the Bank of Canada. Now, moving forward, let's talk in a little bit more detail about why the bank is so confident in their inflation trajectory. Unemployment, as I've mentioned, has been rising sharply. Vacancy rates for jobs are down. We know there's excess supply now of labor. Inflation expectations for both businesses and consumers have been falling, and corporate pricing behavior is improving. Also, what is helpful in the next couple of months is the base effects in the next 2 months are working in favor of lower inflation rather than higher inflation. And as I mentioned, wage growth is falling, keeping in mind that wages are a lagging indicator. The markets are now predicting the overnight rate will fall to 2.75%, which is the midpoint of the Bank of Canada's estimate for the neutral interest rate. They define neutrality as neither causing a inflation nor recession. In other words, it's the level of interest rates that's consistent with inflation at the target 2% range. And then finally, another factor pointing to this downward momentum in inflation is the general economy, with renewals at very high rates and the renewals occurring at higher monthly payments than 3 to 5 years ago when these mortgages were initiated. We see a reduction in discretionary spending by consumers continuing. So all of this points toward further easing and an improvement in the Canadian housing market. So the next chart begins the more detailed discussion of Canadian housing. Now, for the month of June, we saw on a monthly basis a 0.1% uptick in home sales. So it wasn't the data, though they didn't get a lot of attention. They weren't nearly as negative as some were expecting. Mortgage originations, the next chart in the deck, as you see here, plummeted in the first quarter. Mortgage originations have picked up in the second quarter, but as the year progresses, I think we're going to see a further improvement in housing activity. Now, turning to the next chart, you see here that home sales are running well below the 10-year monthly average for the month of June. Yes, they ticked up a little bit from the prior month, but still far below the peak levels of home sales, monthly home sales, that we saw when the Bank of Canada had taken interest rates down to a mere 25 basis points in the early 2020s in response to the COVID lockdowns. The next chart shows us that home sales were soft in the spring, and the second quarter home sales numbers did tick down a bit from the first quarter. What we have also seen, as the next chart shows you, is that new listings have edged upward, as there's much in the way of pent-up demand or pent-up supply, as many who have been reluctant to put their homes on the market are beginning to think that the time is right to do so. So supply is increasing. And the next chart shows you the months of inventory have edged down, as well as the sales to new listings ratios. So more excess supply in the housing market. If we do see further rate cuts, as I'm predicting, we could well see a boost in the fall housing market, which is seasonally unusual, but these are very unusual times. Now let's look at the benchmark prices for housing in the next chart. Here you see that Home prices were flat in June. Clearly, home prices have dipped since the peak back in the middle of 2021. But we haven't seen massive declines in home prices recently, which is, it certainly does beg the question of affordability. So what does this mean then for borrowers in the future? The next chart shows you just, making these decisions about fixed versus variable. And it very much depends on the risk profile of the individual borrower, as well as what exactly you do predict for upcoming changes in interest rates. What we have seen, as the next chart shows you, is that the most popular mortgages taken out in the last year have been in the shorter term fixed rate space. So 70% of new mortgage borrowing has been in the 1 to 4 year fixed rate space. Likely that 1 to 3 year area will continue to be popular, but as we see future rate cuts, we will see finally people moving back into, maybe tiptoeing back into variable rate loans. But there is considerable payment shock out there. The next chart shows you that more than 70% of mortgages will come up for renewal in the next 3 years. And this just shows you the forecast curve for 5-year fixed versus variable. You can see that fixed mortgage rates still are well below the variable rates and will likely remain so for some time. So inflation risk still lurks out there. And term selection is largely about risk management. Now, the biggest component of what we're seeing in terms of demand and supply is immigration. The next chart just gives you a graphic of that. This is what I had mentioned earlier about the payment shock. We can move on to the next chart. Immigration continues very, very strong. And as the following chart shows you, Canada added a record 1.3 million people in 2023, the fastest pace among advanced economies, rivaling the least developed nations. You can change that chart now, Natasha. So you see that we are still seeing the fastest pace in population growth since the 1950s. And then changing that chart again, planned permanent immigration for next year and the year after is at 500,000. The Bank of Canada and the federal government have suggested that they're going to temper temporary workers. By far, the numbers, these permanent entrants into the population are dwarfed by the influx of foreign students and temporary workers hoping to get permanent residency. If you turn the page now, you see that immigration has done many things, and it has boosted the tremendous shortage of housing in Canada. And the impact of that is reflected both in terms of rising rents and rising demand for housing, where, just trying to straighten out my picture here. Okay, where there is considerable upward pressure as a result of just so many new entrants to the labor force. So what the federal government has decided, and the next chart shows this, is that they're going to put a cap on temporary residents. They've already capped foreign student numbers, and now they're going to, in my view, what they're going to do is many of these foreign residents, these temporary workers, will quickly be moved into the permanent worker bucket, as well as the government slowing population growth from roughly 3% to about 1 to 2% as we move through 2025 and 2026. So you can change the slide here as well. So as a result, rent inflation is peaking, and the population growth, of course, is also peaking, which will help to improve housing affordability, albeit gradually. The next page shows you that the annual rent hikes have averaged 9.1% in the past 3 years. But if you were to include 2020 and 2021, where we saw declines in rent as a result of COVID, the 5-year average annual rent growth falls to 4.7%. So moving to the next slide and wrapping up my formal remarks, the housing shortage remains. Our government at all levels is working hard to increase housing supply, but there are tremendous impediments to this. The next chart shows you that there is no way we're going to meet housing demand by dramatically increasing completions. It would take 500,000 housing completions per year to meet the surge in housing demand. We've never seen even half that amount in a single year. And the latest data on housing starts has shown that starts are running pretty much in line with where they were back in the 1970s. The next chart shows you this, that right now only one housing start per 4.9 people in the working age population is what we're seeing. The historical norm for that number would be one start per 1.8 working age people. So this is, one of the underlying fundamentals to exactly what we've seen in terms of the inaffordability of housing. So the next chart shows you just how inadequate housing starts are. And as I drew that line back to the 1970s, you can see that population was running at about 20 million back then. Now it's over 40 million, and yet housing starts are running at about the same pace. So again, we're still in the thick of excess demand for housing, even though housing activity has slowed considerably. And the final chart shows the primary reason for the difficulty in meeting demand for housing is that there's a shortage of construction workers. We need roughly 100,000 new construction workers annually. And because most Canadian kids would prefer to go to university rather than into the trades, many of these workers are temporary foreign workers. And that's something that the government is going to need to target, that they bring in more permanent construction workers, especially those that are already very experienced and high levels of training. So this is the bottom line here. I'm happy to open it up for questions and comments. And I can tell you that I'm more confident today than I have been in quite some time that we will see further aggressive easing by the Bank of Canada, and that the incoming data will not derail the prospects of actually cutting interest rates over the course of the next 3 meetings for this year, and then through much of 2025 until the overnight rate is at 2.75%, much lower than the current level of 4.5%. Thanks, Greg.
Excellent. Once again, Sherry. Ooh, there we are. Just very informative and just great news. I think there's a lot of positive there. I got to, again, tip my hat to your 6 cents. You once again did it where you predicted a 1/4 point reduction, and that's what we delivered, which is going to be the start of a good momentum. I did have wanted to kind of just summarize or clarify a couple of comments, but then just the biggest takeaways is, like, right now we're looking for more mortgage origination, and with the bond yields dropped by 20%, that's going to drive down the fixed rates as you predicted. Variable rates are going to be dropping by a 1/4 point, so definitely good news that with the Bank of Canada's meeting today, rates are on the fall, which hopefully in turn is going to spur on some great housing activities, because that demand is definitely huge in relation to how many houses are available. One thing I wanted to clarify, with such an influx of immigration, and I know you said this on the last slide, with such an influx of immigration, but yet such a high demand of construction workers, what is the country going to do to really focus on bringing in these immigrants that do have the construction skills to help battle this demand? Can they pick and choose who they allow in? Do they do marketing to attract?
Well, yes, all of the above. And in fact, as I mentioned, that the government has not been targeting permanent workers as construction workers. And that's something that I think will shift, because they want to keep a lid on population growth in 2025, but they still want to bring in 500,000 permanent workers. They say they're going to reduce the temporary workers, including students. So I think by definition, that means that we need to see construction workers, and many of them will have permanent opportunities within Canada.
Would it be easier for a skilled construction worker to be granted the access into Canada through immigration based on this?
That's the idea. Now, I mean, how well this actually works is yet to be seen. And we also know that there will be an election in Canada by the end of 2025. And right now, the Trudeau government is not very popular. So new government, new federal government, all bets are off. Who knows what will happen? This geopolitical uncertainty, of course, is not just a Canadian phenomenon. It's running rampant in the United States as well as Europe. So lots of unknowns still, lots of uncertainty as always. But I do think that the worst is over for inflation and therefore high interest rates.
Well, let's turn our attention to some of the questions that are in the queue here. And again, for those folks that are with us, if you do have some questions that you'd like me to table in front of Dr. Sherry Cooper, just type them into the comment section. So our first question I want to put in front of you, Sherry, is from Etan. Will there be any sort of stimulus from the government like how the U.S. has continued to pump money into the market?
Well, our federal government budget deficits are already very high. And so I think that the feds are going to have a lot of difficulty selling further fiscal stimulus. Now, remember, they just increased the capital gains tax, which is certainly unpopular among many circles. It has impacted the housing market, and particularly for investment properties, but also for second properties where capital gains must be paid. And that's slowed activity. So, it's like there's a real balancing act here. And though those spending increases are always popular, I think that given the improvement in the polling for the Conservatives is going to make it very difficult for the Liberals to bring forward a lot more spending.
I agree. So moving on to our next question. Some scary stats over the last few years. Mortgage foreclosures and mortgage delinquencies have been on the rise. What are your thoughts on 225 forecast of foreclosures lasting into 25 and 26.
Well, you know what? Even though those numbers are trending higher, they are still extremely low by both global standards and historical perspectives. Canadians are very reluctant to walk away from their homes, obviously. So, yes, if we were to see a dramatic increase in the unemployment rate and a deep recession, no question those numbers would deteriorate. But so far, they vary from region to region. The highest number of delinquencies is in Saskatchewan, and they still remain relatively low by historical perspective.
And that's obviously going to have an impact, as you said earlier, with the high amount of renewals that are upon us, and people are renewing at higher rates than they were 5 years ago. But it's nice to see that the consumers have control of their spending, even though it does have an impact on the economy. As the renewal rates are up, they're spending less just to kind of maintain that quality of life, right? So they don't have to walk away from their home. So good comment that, yes, Nina, the foreclosure and delinquencies have been on the rise, but they're still overall low compared to the world economy, right?
Yes.
So Sean's asking this next question. When do you predict that lenders will stop passing along the Bank of Canada's policy rate cuts to the borrowers?
Well, I don't think they will. I think that it's not just the Bank of Canada's policy rate cuts that determine mortgage rates, but it's also the level of bond yields. And
Right.
bonds have been rallying even without the, in between the meetings of central banks. So the fact that we've got a 20 basis point cut in 1 month in the 5-year fixed rate, and I'm sorry, the 5-year government bond means that 5-year fixed mortgage rates come down. And similarly, the decline in the prime rate generated today will be good news for the variable rate loans.
But the 5-year bond rate has a nice reduction, but as you said, majority of consumers have been taking the shorter terms of the 1 and 3, which do have different bond measurements, right?
But the 2-year bond yield came down sharply today too. So markets are driving down mortgage rates as a result of lower inflation in this country.
All right, next question for you, Dr. Sherry Cooper. This is my buddy Peter. Dr. Sherry, do you believe the stress test is too punitive for home buyers? I think we get this question every time we have this show.
Yeah,
do you think the stress test should be repealed or relaxed? And I think I know your answer because it's been the same every time you've been asked this.
Yeah, it's not going to happen. And I doubt that it should. And the reason is because it protected consumers over the course of these enormous increases in interest rates in the last few years. And if anything, the regulator, OSFI,
Nope, we've got our frozen screen. Not sure, Natasha, is that me or is that Sherry's end where we're frozen? She's frozen. All right. Well, let's see if Sherry can come back online. Looks like she's got some technical problems on her end. We do have some few questions still to get through. But in the meantime, I just kind of wanted to recap again some positive news, some positive stats. But I also wanted to point out with the sheer number of new immigrants that are coming into Canada, that are slotted to come to Canada, but also just with our own organic growth of population, it's nice to see that the mortgage professional industry, particularly Dominion Lending Centers, the use of a mortgage broker is growing respectively. Particularly with new immigrants coming to Canada, there seems to be a huge increase in the trust and use of mortgage professionals as these new immigrants come into Canada, but also the first-time buyers. As our organic population bursts and grows, we have a huge increase in, again, the first-time buyers using mortgage professionals. So it is nice to see that consumers are not just trusting one source, maybe their traditional bank. They are reaching out to the mortgage professionals to give them some more additional advice and help in this ever-changing market because rates are changing daily. It's nice to see them coming down on the lower end of the scale, but it still deems the question, should the consumers be now moving into the variable rate market? Should they stick taking the shorter terms? And I like Dr. Sherry's comment where she does believe that consumers are going to start to tiptoe back into the variable rate market because variable rate is a great way of looking at it where, how do variable rates perform over the long term, over a 25-year history? And yes, they're high right now, but they're starting to come down, but variable rates have always performed quite well in the long term. So I think we're definitely going to see consumers having more conversations with us mortgage professionals as to, is it time to tiptoe back into the variable rate? Is it time to stick with fixed? But very positive announcements today with once more fixed rate bond yields on the 5-year have dropped. But as Sherry just said, that the 2-year bond yields have dropped, which does mean that our mortgage lenders should be dropping their fixed rates once again in the next few days. Variable rate has dropped, or Bank of Canada overnight rate has dropped, which means that our variable rates are going to drop. So dropping is a good thing. When housing prices have not really risen too much, it's time to maybe get these rates a bit lower so people can then start to get off the sidelines and start buying some houses again. Also, just some other little notes I made that are quite interesting to brag about. We always talk about the Canadian dollar and how the Canadian dollar compares to the US dollar. Of course, there's a direct correlation between our two economies, and it's very difficult for Canadians to go down south to the States as the Canadian dollar doesn't perform as well. But what a cool stat that in relation to the world markets, the Canadian dollar is actually quite strong. It's just that one segment in the States where it doesn't have a good comparison. But hey, time to travel the world because the Canadian dollar is quite strong overseas and in some of our Asian countries. Other comments I wanted to talk about. New listings are on the uprise. So I think there has been people waiting on the sidelines for a long time. Is it time to sell their house? Is it time to downsize, upgrade? But with the demand so strong and the inventory so low, it's going to be great and exciting news to see that housing listings are starting to rise, and we should see some pretty big activity, especially with the Bank of Canada meeting 3 more times this year. Once more, those dates are the next Bank of Canada meeting is September 4th, then October 23rd, and December the 11th. So we have 3 more opportunities for the Bank of Canada to reevaluate our rates, both fixed and variable, and see what's going to happen. And to quote Sherry one more time, she predicts that the overnight rate by the end of 2025 is going to be 2 3/4, which is something we haven't seen in a long time. So positive news from the Bank of Canada meeting today. I think it's very positive news for the Canadian consumers to maybe it's time to get off those sidelines and list your house. This heightened activity is going to probably drive those prices up slightly. So this is a good news for the economy that wants to sell their properties. But obviously, the more listings that are available, this is good news for the massive demand for properties, especially when rent is going so high. It's very common that you get into the housing market, your mortgage payment is going to be lower than your rent payment. So let's see what that does. So once more time, September the 4th, October 23rd, December the 11th. We do have 3 more Bank of Canada meetings, and our amazing, brilliant, 6th Sense Chief Economist, Dr. Sherry Cooper, is predicting more rate drops in the next few meetings. So looks like we're not going to get Dr. Sherry Cooper back with us as her technology is definitely giving her some grief. But let me thank our sponsor one more time, First Canadian Title. Dominion Lending Centers wouldn't be the company we are without such a great partner. So thanks for sponsoring the show, First Canadian Title, FCT, and stay tuned for our next In Conversation With, which will be on September the 4th. There are some questions that we didn't get to due to Sherry's not ability to finish off the call. I'm not going to take a stab at answering the questions, but what we'll do is for those who have asked questions, we'll see if we can get the answers from Dr. Sherry Cooper over to you by email or some sort of format. So that, I guess, will conclude our show today. Thanks for everyone that participated in hanging out with me, Greg Donville, and our Chief Economist, Dr. Sherry Cooper. We will see you once more on September the 4th for our next In Conversation with Dr. Sherry Cooper. Thanks all. Have an excellent rest of your week, and we'll see you in September.